Hello everyone, welcome back. I got some really good ones for you today on this Sunday, November 12th, 2023. A lot's been going on with the markets, and that's what we're going to be focusing on for today's video. So welcome back, glad you made it, glad we could hang out together, and let's dive right into these markets, shall we? We'll start with the bond market. We always start with the bond market because it's the largest market on planet Earth. It gives cues to every other market on how to behave because we're talking about the dollar. You know, if your favorite asset class is like fine art, or beanie babies, well, these things are denominated in US dollars. So understanding the debt market, what's going on with the dollar, credit, that's going to give you a pretty good idea of where the price of your favorite asset class is going to go. So always start with the bond market because, like, let's say you're into crypto, okay? Well, Bitcoin as a market cap, the total size of the Bitcoin market, just Bitcoin by itself, that's $500 billion. And then the altcoins like Ethereum, Solana, Avalanche, whatever, Chainlink, Uniswap, you add all the other altcoins up, that's about 500 billion, half a trillion. So you put it all together, the crypto market has about $1 trillion market cap. Let's say you're an expert, that's where you like to hang out. Those are the tables in the rigged casino you like to bet the most hands, I guess you could say. Well, you're going to want to really pay attention to the $200 trillion debt market because your asset class, crypto, it's only $1 trillion. You got the debt market, 200 trillion, stock market, 50 trillion, gold market, 13 trillion. So you can see how these larger markets, especially the debt market, the mother of all markets, can ultimately have knock-on effects that affect the price of your favorite asset class. So starting with that bond market, we saw the 10-year yield about a week and a half ago, right before the Federal Reserve concluded their FOMC meeting. We saw a 10-year yield that was hanging out around 5%. That was putting a lot of downward pressure pretty much on every asset class because when you have yields rising that quickly, that's the bond bubble just getting drained. And if it's very volatile and happening super quickly, instability in the largest market on planet Earth, the U.S. bond market, instability there can really send shock waves out to the end of the risk curve in the much smaller markets like the $1 trillion crypto market. So you always got to start with the debt market, and we had a yield 5% about a week and a half ago for the 10-year. That was just too high, guys. However, the Fed concluded their policy meeting about a week and a half ago, kept rates steady, which is their way of trying to keep yields from rising any further, keep interest rates from rising any further. They didn't want to do any more interest rate hikes a week and a half ago, and the market read that as a good thing. Markets all inflated about a week and a half ago as soon as Jerome Powell concluded his FOMC meeting, Federal Open Market Committee meeting. They kept the rates steady. The market read that as like bullish and a reason to inflate because, when you kind of read between the lines with Powell's rhetoric, he's talking about the Fed's argument over doing too much to raise interest rates, doing too little. They say that's better in balance. Put another way, about a year and a half ago, the Fed was really concerned that they weren't doing enough to raise interest rates aggressively, quickly enough, fast enough, and that really freaked the markets out because when you raise interest rates, you're raising the value of the dollar, you're raising the rent paid on dollars, and you're also moving people to dollars. So when you raise the interest rate, like, put it this way, if I only pay you 1% on your savings account, well, you're not really making any money there. You put $1,000 in your savings account, you get 1%. What is that, like $10? But if I told you the interest rate on your savings account was 20% and you put $1,000 in there and you got $200 a year, well, a lot of people would be moving their wealth into cash, fixed income as a position, and that kind of draining of cash out of markets, equities, can cause a lot of dollar strength and cause a lot of weakness in risk assets. Because why would you put all your cash into Bitcoin when you could just park your cash in a savings account? And if the interest rate was 20%, just totally clean up there. You're making 20% per year, you might as well just hang out in cash, right? So if the Federal Reserve had increased the interest rate a week and a half ago, it would have put more downward pressure on risk assets and stocks and beanie babies and crypto and gold and oil. But because the Fed held rates steady, the market really read that as bullish. The market really sees the Fed more in a posture of kind of like maybe squeeze off 1 or 2 more interest rate hikes in the coming weeks and months. We might see one more interest rate hike, you guys, for November or December, but I think that's about it. And that's really all this game right now has been about last few weeks, is just what's the direction of interest rates? Is the Fed done raising interest rates? Have we reached peak rates? And if that's true, well, then markets have a lot of room to move higher, because as soon as the Fed starts to cut interest rates, that's going to be rocket fuel for things like the stock market, oil, Bitcoin, and gold. So you can kind of see how this discussion the Fed keeps having around interest rates is really sending markets higher or lower. And just to kind of reinforce that notion, so we had Powell a week and a half ago come out kind of acting a little bit dovish, less hawkish, less talking about getting inflation under control, less talking about being worried that they might need a lot more interest rate hikes, So as Powell kind of tones down his aggressive interest rate hiking hawkish rhetoric, as he kind of tones that down, markets kind of inflate on that. And then, the Fed wanted to see how markets reacted to their interest rate decision about a week and a half ago. We talk about in this channel how it takes about 3 or 4 days to digest the Fed burrito. So whenever the Fed makes an interest rate decision, markets kind of like, I don't know, do I like this? Do I hate this? That those hours and days immediately following a Fed decision can be very volatile. And, the market can pump and then dump and dump and then pump. But after about 3 or 4 days, Powell could kind of see how the market was digesting the interest rate hike decision. And he kind of read it as the market got a little too giddy and a little too bullish off of his comments a week and a half ago, because then we had Powell come back a few days ago, like on Wednesday or Thursday, and smack the markets back down with his rhetoric about interest rates not being high enough. Maybe we do need 1 or 2 more hikes. So basically what happened is, a few weeks ago, markets are really selling off because they're worried that the Fed's going to keep raising interest rates, and bond yields kept moving higher, and this is pushing stocks and gold and crypto and oil lower. And then the Fed came out and gave their speech, and they're like, we're really not going to be as aggressive as you kind of think we are. So the market's shooting up now, like, oh, this is a bullish read. The Fed is starting to flip dovish and get away from their hawkish rhetoric. And then Powell kind of sees the markets moving up a little bit too much over the past week and a half, and so then he comes out a couple days ago, kind of smack things back down. Well, maybe we do need more interest rate hikes. Maybe we haven't done enough to fix inflation. So this is how the Fed uses their rhetoric to kind of manage markets. And have you noticed they don't even need to use policy yet? It's just rhetoric, guys. So if Jerome Powell came out tomorrow on Monday and said, to heck with it, we're done raising interest rates for good. Next thing we do will be a cut, and we'll take it meeting by meeting, markets would shoot to the moon. On the flip side of that, if Powell came out tomorrow and said, interest rates are going a lot higher, we're breaking the back of inflation, we might even take the interest rate on savings and checking accounts up to 15% to get this inflation under control. We want to take bond yields to 15 to 20% to get this inflation under control. Well, that would send markets, crashing. Stocks, oil, Bitcoin, gold, they would all just start to tumble. So you can see how the Fed just can kind of use their rhetoric to manage the markets, and you're seeing a little bit of that. As soon as the Fed came out a week and a half ago and made their interest rate decision to hold rates steady as opposed to continue raising them, as soon as Powell did that, the 10-year yield fell from 5.5% down to 4.64%, 4.5%. A 0.5% move in the 10-year yield, that is a mondo-sized move. And so what you saw there was a bunch of cash flowing into the bond market, propping the bond market back up and driving yields lower and the dollar lower, which if the dollar and yields are moving lower, inflation's moving higher. So the stock market took that as a read, like yields are coming down a lot, money is flooding back into the debt market to kind of stabilize it. Now I'm back, I'm risk on again. I see those yields coming down, I'm risk on again. So yields were high a week and a half ago. Powell held rates steady. Yields fell. Yields falling was a reason for stocks to inflate. Stocks inflated. Powell saw stocks inflating maybe a little bit too quickly, came back out, poured some cold water on it, talking about more rate hikes being needed. Markets sold off again. That's basically what you've had happen over the last week or so. S&P 500, so we'll move on to the stock market. The S&P 500 right now hanging out at about 4415, 4,415. I think a good end of year target would be like 4,500, 4,600. So there you go. Write that down on a little napkin, put it by your computer, a little sticky note, put it on your monitor on your desktop. Hey, Mike says S&P 500 should be about 4,500, 4,600 by the end of the year. Let's revisit that, But the market moved up over the last week and a half or so, net. We saw a nice little pop on Friday too. So S&P 500, pretty comfortable spot, hanging out in the mid 4,000s. The NASDAQ creeping up on 14,000, you know, that's pretty good to see. We got the Dow Jones hanging out around 34,283. So yeah, guys, an S&P 500, 4,500, NASDAQ closing in on 14,000, a Dow Jones of 35,000. That's a pretty inflated market. You know, the Dow Jones was created in 1896. Fun fact for you, that's the oldest stock indice. But it's also the lamest one. The Dow Jones, it only tells you, it's only indexing about 30 large cap companies. If you want a really better barometer for how the stock market is doing, I would look more at the S&P 500. That's the 500 largest corporations indexed. And then I would look at the NASDAQ. So the S&P 500 and the NASDAQ are better indicators for stock market health than the Dow Jones. But we watch the Dow Jones. I mean, we've been watching the Dow Jones since 1896. So good for the Dow Jones. You know, the companies, though, that comprise the Dow Jones, that changes. So don't be like, oh, so the Dow Jones is 30 companies and the Dow Jones was created in 1896 and it's still the same 30 companies. No, guys. A company will go into the Dow Jones and then they'll take a component out. You know, that kind of happens over the years. But the Dow Jones does say, you know, tried and true index. So there you go, guys. Dow Jones hanging out around 34,283, you know, up there. NASDAQ, up there. S&P 500, up there. Cramer came out on CNBC about a year ago when I did my inverse Cramer video. He came out at NASDAQ 10,000 saying to recession-proof your portfolio. Yeah, how's that going? Where here we are a year later and the NASDAQ's up like 38% year over year, something like that. Insane, guys. So right when Cramer told you to recession-proof your portfolio and get tiny and scared and move to cash, and he told you to abandon high-growth tech, yeah, that was the bottom, and you missed a 50% move in tech. So thanks, Cramer. So moving on to precious metals, we have gold right now hanging out at $19.38 an ounce. You know, pretty close to all-time highs. I'd say if we were at like $21.50, we'd be pressing into all-time high territory, but you know, not too far off of all-time highs, $19.38 per ounce. It's doing its job, you guys. Gold is not that exciting. It's actually, in my opinion, the most stable asset class on planet Earth, because when you watch the gold price change, you're not really watching gold's value judgment changing. It's an unchanging unit of account. You're watching fluctuations in the credit market and the dollar and the debt market, you see. So gold is really, an ounce of gold is an ounce of gold. It was worth a tunic and belt and sandals in ancient Rome, and today that 1 ounce gold coin gets, you know, $2,000, 1938, gets you a nice suit. So the value judgment on 1 ounce gold coin hasn't changed for 10,000 years, maybe a little bit, but not much. It's the most stable asset class on planet Earth, in my opinion, you guys. So you don't buy gold to get rich, you buy gold to stay rich. What's up? You want to do a little bit of stacking? Good on you. If not, whatever, you don't have to. A lot of people don't like gold. A lot of people don't like Bitcoin, you know, whatever. But gold hanging out at 1938, I like it here, I guess. Do a little bit of stacking. You know, if I stack physical precious metals, I'm not really letting price inform my decision that much. It's really just a stack steadily for the long term. Whenever you have the disposable income, set and forget. That's it. You know, never sell it kind of thing. It's there for you when you need it. Silver hanging out at 22.31. You know, gold and silver both got smacked pretty good this last week and a half. So if they fall out of favor and you're not really hearing much about them in the headlines, that could be your chance to kind of swoop in the back door and do a little bit of stacking, or not. Oil saw a nice pop on Friday, but still down week over week. We're down to $77.35 a barrel for WTI crude. You know, I didn't think we were going to dip that much further below 90, but boy, we've tumbled all the way down to 77.35. And with two wars going on, you know, it could be a buy the dip moment. We're just going to have to wait and see. If you were looking for energy exposure, nothing on this channel is a buy or sell recommendation. I don't do those, guys. You got to just take the information and make your own decisions. But you could look at the mega cap, large cap oil producers like Exxon, Chevron, Halliburton, BP. You know, take a look at the big boys. You don't have to get cute with it. You don't have to buy exploration companies. You don't have to buy these micro cap oil service sector companies. Like you can just kind of keep it 100 and buy the mega cap energy stocks like Chevron, Exxon. You know, never sell them. That could, you know, or not. But hey, the odds that Chevron remains a dominant player, Exxon remains a dominant player tomorrow, and when we wake up next week, and when we wake up a month from now, pretty high. To those that have more is given, a lot of these dominant players, they stay on the leaderboard like forever. ExxonMobil has a $500 billion market cap. So that's a $500 billion company right there, Exxon, you guys. And you might be like, well, you got to get away from energy and Exxon and Chevron because we're having this like green revolution. We have these ESG, environmental social governance policies that are coming out to kind of green the Fed, green our economy, green transportation, green the military. Just a real shift in sentiment in favor of sustainability, saving the environment. But guys, Exxon and Chevron, they're gonna lead the way on a lot of this too. A lot of the research and design that Exxon and Chevron are able to do, it'd blow your socks off. I'm sure as far as sustainability is concerned, for every $1 billion a large solar company could drop into research and design, Exxon could drop 20 billion into, so I think ultimately they're going to be the ones leading the way in more sustainable efforts. And assuming your civilization is growing, well, your energy needs are infinite, you guys. Like, it's just facts of life, like we're going to need cheap available energy if we want to have an arbitrarily high and good standard of living. So just facts of life. I'm ready to pivot when it's feasible to, but we're still kind of stuck on oil and gas. It's still like 88% of the grid. So if you're charging a Tesla and you're like, well, I'm saving the environment, dude, you're charging on coal, natural gas, and oil. You know what I mean? It's still some 80% of the grid is non-renewable, So we'll get there, guys. It just never happens quick enough kind of thing. But anyway, oil had a nice pop on Friday. You could look to buy the dip in energy if you're into that kind of thing. If not, whatever. Moving on to crypto, we have Bitcoin right now hanging out at 37,156. That's awesome, guys, that Bitcoin's popped above 35,000 and is holding it. I guess now we're going to have pretty strong support, psychological support at 35,000. It's going to be hard just to break down below 35,000, let alone do a lot more damage to Bitcoin. So, potentially. Put it this way, could Bitcoin trade back down into the high 20s? Absolutely, guys. It could trade down to cost, so like 16, 17,000. But do I think it's going to? No. Realistically, I think Bitcoin at 37,000, it's going to struggle at 42,000 for resistance. So as Bitcoin moves up to that 40, 42, 42, you might be like, why are you picking 42 and not 40 for resistance? Because after having watched Bitcoin for several years, it always thinks really hard about the $42,000 price tag. On the way up, it has to stop and think about it for like 6 weeks. And on the way down, it has to like hold 42,000 and just really think about 42,000. So, if we're at 37,000 now and Bitcoin starts moving up, I would say we're going to run into some resistance at 42,000. And then if Bitcoin starts to dip, call it to like down to 35, we're going to see how long we can hold 35 as support. And if we were to break down from there, I'd say the next resistance probably around 30, 31. Or next support, excuse me. It's probably around 30, 31. So you have like support, right? Which is where every time a security trades to this price, buyers step back in. So it's like we're at $1.10, and every time we bounce off $1, buyers come back. We hit 99 cents, buyers come back. So that's your support. And then you could say, and every time we hit $1.25, we run into resistance. The market just does not want to let it go above $1.25. Anytime we hit $1.25, you have sellers. So there you go. You have support and resistance, but don't, and that is technical analysis. But so I use it, roughly. I'll eye a chart. I'll look for major supports and major resistances, guys. And maybe I'll look at some moving averages, but I'm not going to get into these weird technical indicators like MACD crosses and there's, Elliott wave analysis, or even like Fibonacci can get a little bit weird. So if you're into TA, it's like adding mirrors to a car, technical analysis. It might help you drive better, might keep you from getting into some accidents, might help you manage your entries and exits a little better. But is it the end all be all? No. Technical analysis, technicians and traders especially like to think that, but past a couple indicators, you're really creating such a cloudy picture. You're getting all these mixed signals. And honestly, guys, indicators work some of the time, but just all in probabilities, guys. TA is a rabbit hole, and the deeper down that rabbit hole I've gone, just my experience, the more I've realized there's nothing down there, so be a little bit faster and looser with your technical analysis. Moving on, we have Ethereum hanging out at 2053. Pretty awesome to see as well. I think we just went through a pretty horrible crypto winter, especially for these altcoins. I mean, Bitcoin got beaten up enough just in that dip all the way down to like 17,000. But guys, some of these altcoins were just completely wiped out. We're talking about 98% corrections. So seeing Ethereum hold that 1500 level through the worst crypto winter ever, pretty promising. So ETH getting back above 2000, guys, hasn't been up here since the last bull market. It's been a pretty nasty crypto winner. So tentatively bullish on some of these altcoins too. You can take a look at projects like Solana, Chainlink, Pepe. There's a lot that you could look at. Ethereum, obviously. So that's really all I got for you guys for right now. Thanks for hanging out with me. We'll reconvene as things progress, and we're just going to keep going, all right? Till next time.